New Jersey's housing market is catching its breath, but not cooling. Prices are up, time to sell is stretching, and the money behind warehouses and offices is moving with caution and intent. Start with the home. In June 2025, New Jersey's median sale price reached $581,900, up 6.0% year over year. That same month, 8,248 homes changed hands across the state. Yet the median days on market rose to 35. Sellers got more, but they waited longer to get it. Inventory crept higher too, up 1.3% year over year in June. It's not a flood of listings. It's a trickle, the kind that can shift behavior before it shifts outcomes. What changed underneath? In the second half of 2025, the benchmark interest rate stepped down 3 times, lowering its range from 4.25% to 4.5% to a new range of 3.5% to 3.7%. That's policy, moving from restraint toward stability. Mortgage rates followed only partially. For most of 2025, the 30-year fixed hovered around 6.7%. Across the year, borrowers saw the low 6% to low 7% range, with a slight easing after those cuts. The message wasn't rates crashing back to 4 or 5. The message was steadier ground. Signals for 2026 to steadier still. Forecasts cluster around the low 6s. An average near 6.3% for the 30-year fixed in some projections, with ranges from 5.9 to 6.9%, and another estimate of about 6.4%. Others put the year closer to 6%, but expect rates to remain above 6%, even with one additional quarter-point cut penciled in for the year. Stability matters. It's easier to plan a life and a bib when your financing cost isn't swinging week to week. Sellers feel it too. Active listings increased nationwide in 2025. Estimates ranged from 17% to 33% year-over-year growth. Into 2026, more gains are expected. One view projects an 8.9% increase in active listings, though inventory would still sit about 12% below pre-2020 averages. That's up from a roughly 19% shortfall in 2025 and nearly 30% in 24. Another outlook calls for up to a 10% increase in the number of homes listed. Rising supply meets steadier rates. That's the foundation of a healthier market. Sales volumes are likely to push higher on that foundation. Expectations range from a modest 1.7% increase to a stronger 14% in existing home sales in 26. Several positions fill the middle: 3%, 4.2%, and 5% gains. That spread captures a market negotiating new norms. Buyers are less inclined to wave everything just to win. Sellers are letting go of last cycle's price fantasies. The wide gap that opened between listings and closed units in 2025 is expected to shrink as both sides adjust to these conditions. Price growth, too, is recalibrating. Nationwide in 2025, home prices grew at a more modest pace, between 1.7% and 4% year over year. For 26, most expectations sit in the 0.5% to 4% range, with multiple forecasts converging on 1 to 3% as steady growth. Some places will cool more than others. Areas that saw outsized pandemic-era surges are seeing more softening now. In New Jersey, widespread declines are less evident so far, but the tone has changed. Slower ascent, more frictions, fewer bidding wars. Across the river of residential is the spine of logistics. 2025 was a transitional year for industrial real estate. National in-place rents averaged $8.76 per square foot at the start of December, up 5.7% year over year. The national industrial vacancy rate finished November at 9.7%, 220 basis points higher than a year earlier. Under construction, 382.7 million square feet of industrial space was underway nationwide at the start of December. Year-to-date completions totaled 265.7 million square feet. Starts reached 258 million square feet. It's still a lot of building, but a far cry from the frenzy earlier in the decade. Zoom in to the Northeast. Vacancies for industrial space in Boston and New Jersey were almost tied around 11% in November, sitting above the 9.7% national average. Development pipelines in the region were muted by late November. New Jersey's pipeline dipped by 2.4%. With less new supply pressing in, certain lease terms stayed punchy. Boston's newly signed leases in the last year were $3.70 per square foot higher than in-place rates. Bridgeport, Connecticut ran even hotter with spreads of $4.40 per square foot. That kind of premium tells you tenants are still paying up for fresh, well-located space when they have to. The ground truth in Central Jersey backs it up. Two recent leases, 9,000 square feet in Marlborough in Monmouth County and 5,000 square feet in Franklin in Somerset County, moved quickly. The Marlborough deal landed at 4 Timber Lane, a building with 81,100 square feet of space and 18-foot ceilings, multiple loading docks, and drive-in access. The Franklin lease at 14 World's Fair Drive sits within the World's Fair Corporate Center with 18-foot clear heights, wet sprinkler systems, and energy-efficient T5 lighting. These are mid-sized flex spaces, the workhorses of small logistics and light manufacturing. The market for them remains competitive. And the logic is basic: near highways or you're out. For a company needing space now, features like those docks and clear heights translate directly into operational capacity. Now turn to the third leg of the stool: office. The national office vacancy rate was 18.5% in November. That's down 90 basis points year over year, but still elevated. The national average full-service equivalent listing rate in November was $32.77 per square foot, essentially unchanged compared to 12 months prior. Under construction, a little more than 32 million square feet of office space was in the pipeline at the beginning of December. Projects in planning or underway now represent less than 2% of stock nationally, down from roughly 3% a year prior. It's harder to start new office projects when physical occupancy is not rising and the biggest footprints are being right-sized. Even so, demand is not frozen, it's shape-shifting. Co-working expanded in 2,500, 22 million square feet opened, a 16% increase from the year before. That pushed co-working's share above 2% of the office market. Two-thirds of firms offering location flexibility are finding a middle ground between fully remote and fully in-office. Flexible space is catching that middle. The Capitol tells a story, too. Manhattan led year-to-date sales through November, with $7.30 billion in office transactions. The Bay Area followed with $4.40 billion. Washington, D.C. posted $3.60 billion. In the Northeast, Manhattan's listing rates averaged roughly $60 per square foot in November. Boston was second in the region, near $40.09. Philadelphia's listing rates sat near $30. Boston held the largest supply pipeline regionally, with a little more than 4.1 million square feet under construction. Manhattan was close behind with nearly 3 million. Together, Boston and Manhattan accounted for about 22% of the national office pipeline at the start of December. And nearby in New Jersey, office properties tallied a little more than $1.20 billion in sales year-to-date through November, with an average sale price of $156 per square foot. That's the lattice of numbers. Here's the chain that connects them. Mortgage costs steadied after the second half 2025 rate cuts lowered the benchmark range to 3.5% to 3.75%. 30-year mortgage rates responded gradually, holding in the low 6% to low 7% range for much of the year and hovering around 6.7% before easing slightly. Stability in rates feeds confidence. Confidence encourages listings. Listings grew nationally in 2250 between 17% and 33% year over year, an increase expected to extend into a third straight year in 22.6. With inventory still about 12% below pre-2020 levels, even after an anticipated 8.9% rise in active listings, the environment favors smaller, measured price increases rather than spikes. Sales volumes should ride that shift. Expectations for 22.6 range from a 1.7% to a 14% increase in existing home sales. Price growth, meanwhile, is predicted to stay modest, between 0.5% and 4%. New Jersey's June 2017 snapshot shows the dynamic in motion. A 6.0% median price increase to $580,900, 8,248 homes sold in a single month, and the median days on market at 35. Buyers who waited for rates to fall into the fives may keep waiting, but buyers who accept stability over volatility can move before prices climb again. Inside industrial, a different force pulled on the market in 2022. Tariff-driven volatility early in the year prompted stockpiling. Later shifts, delays in implementation and tariff-level cuts added uncertainty. A new tax law favored domestic production while eliminating tax credits for electric vehicles and green tech purchases. That raised questions for parts of manufacturing that had leaned on those incentives while increasing costs for companies exposed to steel and aluminum tariffs. Automation and nearshoring continued to gain traction as responses. The result for industrial real estate was a year of digestion. National vacancy reached 9.7% in November. In-place rents averaged $8.76 per square foot, and pipelines, 382.7 million square feet underway at the start of December, remained large but were already past their peak. In New Jersey and Boston, vacancies near 11% in November put both markets slightly above the national vacancy average. Yet the new lease spreads in the Northeast told a second story. In Boston, leases signed in the last 12 months were £3.70 per square foot higher than in-place rates. In Bridgeport, Connecticut, the premium was $4.40 per square foot. These spreads suggest that tenants are paying above the existing average for better buildings and better locations, even as headline vacancies sit higher. With New Jersey's development pipeline dipping by 2.4% into late November, the balance between demand for quality and limited new supply creates a narrow channel of opportunity. That's the channel the Central Jersey leases ran through. A 9,000 square foot deal in Marlborough at 4 Timber Lane spoke to companies that need the essentials: ceilings high enough to stack product, docks to move it, and the option to roll in and out quickly. The 81,100 square foot building's 18-foot ceilings, multiple loading docks, and drive-in access tick those boxes. A 5,000 square foot lease at 14 World's Fair Drive in Franklin leaned into similar functionality: 18-foot clear heights, a wet sprinkler system, and energy-efficient T5 lighting inside a corporate park. A good fit for production and distribution that doesn't need 1 million square feet to run. Location clinched both. In Central Jersey, proximity to major highways is not a luxury. It's non-negotiable. Meanwhile, office moved under its own gravity. Even with national vacancy at 18.5% in November, some bright spots emerged. Manhattan and Los Angeles averaged some of the lowest vacancy rates among major U.S. office markets that month. Overall listing rates across the country sat at 32.77 cents per square foot in November, nearly identical to a year earlier, while the pipeline under construction shrank to roughly 32.2 million square feet nationwide at the start of December. A year prior, the pipeline represented about 3% of stock. Now, it's below 2%. In a year defined by selective demand, co-working expanded instead. 22nd square feet opened in 25, 16% more than in 22nd's 4, pushing flexible spaces share past 2%. Where companies want flexibility, landlords are following with product. There's another undercurrent: labor. The warehouse and storage sector employed slightly more than 1.8 million workers in November 2020-2000, which was down 1.5% compared to November 2024. After peaking in March 2022, the sector shed more than 120,000 jobs over the following year and a half. Though there were minor rebounds in the summers of 2013 and 2024, the total slid back to a 4-year low. Automation and robotics are doing more even as e-commerce's long-term trend remains intact. For space users, that can mean packing more throughput into the same square footage. For landlords, it means the next lease might require more power and data than the last one. Back on the residential side, the speed versus certainty trade-off is shifting as well. In South Jersey, one Delran-based homebuyer advertised a simple proposition during 2025's runway to 26 cash offers, as is, no commissions, and closings in as little as 7 to 14 days. It's a niche, but it slots into the state's June reality of 35 median days on market. The firm targeted places like Willingboro and Pennsauken while buying across the state. when inventory is rising by 1.3% year over year and more sellers are waiting in, not every home is move-in ready. Speed finds its own price. Everything connects. Rates and inventory steer residential volumes and pricing. Tariffs, tax incentives, and manufacturing strategies reshape industrial demand. Office demand splinters into flexible formats as companies recalibrate footprints. Labor technologies slide into warehouses, allowing output to grow without headcount. And in all of those arenas, New Jersey sits at a crossroads between national macro and local micro. Consider the money behind industrial. Year-to-date, industrial sales reached $67.40 by the end of November 2025 across the U.S., putting the year on track to be the strongest since 2022. In the face of oversupply and policy uncertainty, valuations held competitive. Falling interest rates helped, lowering financing costs and nudging more deals across the line. Regionally, Philadelphia's industrial pipeline stood at 4.7 million square feet by the end of November, ticking up slightly month over month, but still below the prior year. Bridgeport, Connecticut, held at 1.6 million square feet, with no new developments larger than 25,000 square feet breaking ground in November. Vacancies of 5.5% in Bridgeport, up 180 basis points year over year, juxtaposed with those high new lease spreads. It's tight, and it's expensive to sign fresh. On the office ledger, sales in New Jersey tell a calibrated story. A little more than $120 billion in office assets traded through November 2025 at an average of $156 per square foot. Compare that to the national average of $190 per square foot across year-to-date office sales. New Jersey's price point offers relative value, but buyers and sellers are still parsing the path forward. Manhattan's $700.30 billion in sales sets the tempo for the region. Boston and Manhattan's combined 22% share of the national pipeline under construction signals where lenders and builders see durable demand clusters, life sciences, headquarters, amenity-rich, transit-oriented product, while most other markets take smaller, safer steps. For homeowners watching 2026 approach, the numbers draw a workable map. Mortgage rates are broadly expected to stay in the low sixes. Forecasts cluster around an average near 6.3%, with a range framed by 5.9% to 6.9%, and another reading around 6.4%, with still another view at roughly 6% on average for the year. Inventory is expected to rise again, up to an 8.9% increase in active listings, with the distance to pre-2020 levels narrowing to about 12% below, improved from a 19% gap in 2025 and nearly 30% in 2024. Sales volumes are set to increase, somewhere between 1.7% and 14% higher than 21.5% in existing home sales. Price growth looks poised to moderate, between 0.5% and 4% in most projections, with many clustering between 1% and 3%. In New Jersey's lived experience, a 6.0% June year-over-year increase to a $581,900 median sale price, 8,248 homes sold in 1 month, and 35 median days on market combine into a simple message: demand is still there, but the pace is different. For tenants and owners of industrial space, watch the coastal Northeast's leasing math. If new lease spreads like Boston's $3.70 per square foot and Bridgeport's $4.40, that pressure can migrate. With New Jersey's vacancy around 11% in November and its development pipeline dipping by 2.4%, well-located, modern mid-sized units, spaces like 4 Timber Lane in Marlborough and 14 World's Fair Drive in Franklin, will stay competitive. Nationally, with 382.7 million square feet underway at the start of December, 265.7 million square feet already delivered year-to-date, and 258 million square feet started. Total supply is large, but the sharpest surges are behind us. As digestive time progresses, vacancy should start bending lower where demand is steady and supply throttles back. Rent growth that averaged 5.7% nationally over the last 12 months can continue moderating, but sticky premiums on new leases will persist where quality is scarce. For office stakeholders in New Jersey, context is everything. National vacancy at 18.5% in November and listing rates at $32.77 per square foot outline the macro. The pipeline under construction at roughly 32.2 million square feet nationally shows developers are cautious. Manhattan's nearly $68 per square foot asking rates, $7.30 billion in year-to-date sales, and nearly 3 million square feet under construction define a nearby anchor market still able to command attention and capital for select properties. Boston's little more than 4.1 million square feet under construction extends that gravitational field north. New Jersey, with a $1.20 billion year-to-date sales tally at $156 per square foot on average, remains a value story within that orbit. The growth in co-working, 22 million square feet opened in 2025, up 16% year over year, points to user preferences. Those numbers suggest flexible space will continue to capture swings in demand, while traditional leases concentrate in better assets with better locations. Not everything is rosy. Warehouse sector employment at a little over 1.8 million in November 2025, down 1.5% from a year prior, hints at operational shifts. Companies are using automation and robotics to do more with fewer bodies. Over time, that may change how much space is needed per unit of output, and what that space requires. Power, floor loads, data, and ceiling heights matter more when the workforce becomes a fleet of machines. Policy is another wild card. Tariff changes early in 2025 jarred supply lines. Later changes layered on uncertainty by cutting tariff levels and delaying implementations. The year's policy set was the biggest move in tariffs in nearly a century. The new tax law that encourages domestic production, even as it eliminated tax credits for electric vehicles and related green technology purchases, reshaped incentive maps. Signals suggest industrial users in sectors affected by those shifts will pursue locations that hedge cost and supply risk. In the Northeast, with Bridgeport's 5.5% vacancy in November and high new lease premiums, and with Philadelphia's pipeline at 4.7 million square feet but below last year's volume, the region's equilibrium is being redrawn in real time. One small story brings the larger picture into focus. In June, with New Jersey's median days on market at 30-5 and the median sale price at $581,900, one Delran-based buyer stepped into a familiar friction point. The offer was direct: buy houses as is, no commissions or fees, and close in 7 to 14 days. The locations targeted, Willingboro, Pennsauken, and beyond, are places where sellers balancing timelines, repairs, and moving plans often want certainty more than they want to chase the last dollar. In a market where inventory is rising by 1.3% year over year, and more homes arrive not quite ready for retail buyers, speed has a price and stress has a cost. Both show up in the data. From here to the end of 2026, the base case for New Jersey is steady progress with differentiated risks. On the residential side, expect mortgage rates to sit in the low sixes for most of the year, averaging near 6.3% in some outlooks, with ranges framed by 5.9 to 6.9%, and other expectations near 6.4% or roughly 6% on average. Expect active listings to increase, up to an 8.9% gain, narrowing the gap to pre-2020 levels to about 12% below, versus a roughly 19% shortfall in 2025 and nearly 30% in 2024. Expect sales volume to rise in a band between 1.7% and 14% as sellers reset and buyers return. Expect home prices to grow, but slowly, most likely between 1% and 3%, with an outer band between 0.5% and 4% across geographies. In industrial, expect vacancy near the national average to gradually compress where development throttles back and tenant demand remains consistent. With national in-place rents at $8.76 per square foot at the start of December and year-over-year growth at 5.7%, the year ahead should see moderation rather than acceleration. Pay attention to the Northeast's lease spreads. If Boston's $3.70 and Bridgeport's $4.40 premiums shrink, that signals some relief. If they hold or widen, it points to a continuing bifurcation, tenants paying up for the right space while headline vacancy floats above comfort. In office, expect a slow grind rather than a snapback. National vacancy of 18.5% in November looks unlikely to plummet, with pipeline under construction nationally at roughly 32.2 million square feet and co-working's additional 22 million square feet of openings in 22.5 capturing incremental demand. Markets like Manhattan, listing rates near $67 per square foot, nearly $7.30 billion in year-to-date sales, and close to 3 million square feet under construction, will continue to move. New Jersey's $1.20 billion in year-to-date sales, averaging $156 per square foot, shows pricing power where quality and location justify it. But broad-based rent growth without occupancy gains is a tough sell. Two watch items could rewire this base case. First, rate path and credit conditions. The December 2025 projection called for just one more quarter-point cut in 2026. If inflation or growth deviates and pushes rates away from the low sixes on the 30-year mortgage, the easing in inventory could collide with demand again. For sellers, that would lengthen the 35-day median time to sell recorded in June. For buyers, it would stretch affordability even with prices rising more slowly. For commercial investors, sharper rate moves would alter the math behind cap rates, valuations, and deal flow, which already totaled $65.40 billion year-to-date in industrial by November and more than $48 billion in office by that same month. Second, policy and supply chains. Tariff shifts in 2025 were the most significant in nearly a century and caused companies to delay leases, stockpile, and rethink sourcing. If 2026 brings another round of changes, the Northeast's industrial markets, where New Jersey's vacancy sat around 11% in November and pipelines are muted, could swing between tight and tenant-friendly conditions quickly. Watch Bridgeport's 5.5% vacancy and high leasing premiums and Philadelphia's 4.7 million square foot pipeline for early signs. Also watch warehouse sector employment. With a little over 1.8 million workers in November and down 1.5% year-over-year, continued declines would reinforce demand for more power-dense, tech-ready space and could keep mid-sized, well-located New Jersey assets, like those 9,000 and 5,000 square foot leases in Marlborough and Franklin, at the center of competition. Stability is not stasis. In New Jersey, it looks like a market that is learning how to function again without extremes. Mortgage rates largely in the low sixes, inventory edging up, sellers becoming realistic, and buyers adjusting bids to fit a world where more homes are available but fewer are perfect. It looks like mid-sized industrial spaces near highways trading quickly because a loading dock and an 18-foot clear height still beat a promise. It looks like offices that lease when they're flexible, coveted, or central, and wait when they're not. The numbers say momentum is building back the right way. Careful, measured, and real. If you value clear, data-driven coverage of New Jersey real estate, consider following along for the next chapter.